Welcome to the deep dive. If you're keeping tabs on the resource sector,
Huh.
well, you know that jump from development to actual production is huge.
It really is.
And that's exactly what we're seeing with Artemis Gold.
Yeah.
This week, they've just announced commercial production at their Blackwater Mine.
Mm-hmm.
But what's really grabbing attention is this talk about projected low all-in sustaining costs.
Absolutely. And that combination is key. So for this deep dive, we're really going to unpack what this means. Commercial production, low costs. What's the impact for investors?
Right.
We'll look at where they might sit on the Lassonde Curve now. Does hitting production actually trigger that market re-rate people talk about?
Good question.
And then there's the gold price leverage, low costs, and what could be a strong gold market. How does that play out?
And the risks, too, right? They're a single asset producer.
Exactly. We need to cover those risks. And importantly, what Artemis has actually done to, de-risk the project over time.
Okay, so what are we basing this on?
We're looking at Artemis's own news releases, naturally, their 2023 financials. We've got Eldorado Gold's definition of AISC, which is helpful context.
Okay.
Plus market stuff from the World Gold Council, Discovery Alert, and then risk insights from KPMG, IFM Investors, and also Artemis's own statements on their indigenous partnerships.
And all this happening with gold, what, over $3,200 US an ounce recently? According to one source anyway?
Yeah, a pretty supportive backdrop, let's say.
Okay, let's dive in. Commercial production. What does that actually mean day to day, and why the big focus on these low all-in sustaining costs, the AISC?
So commercial production, it basically means the mine isn't just being built or tested anymore. It's running consistently, producing gold at levels that make business sense.
So the revenue starts flowing.
Exactly. It's a shift from spending capital to hopefully generating it. And AISC, well, that's just critical. It's not just the cost of digging rock and getting the gold out today.
It's more than that.
Oh, yeah. Think of it like the total cost of ownership for that ounce of gold. It includes the sustaining capital, the money needed to keep the mine running efficiently.
Okay.
Sustaining exploration to replace reserves, reclamation costs down the line, even corporate overheads. It aims to capture the full cost.
Got it. So when Artemis projects low AISC, what's the immediate takeaway for someone looking at the stock?
Potential for much healthier profit margins. Simple as that, really.
Right.
If your cost per ounce is low and the gold price is, say, $3,200, the gap between your cost and that selling price is your profit margin per ounce. Lower costs mean a wider gap.
Especially potent if gold prices keep rising.
Absolutely. That's the leverage effect we mentioned. A low-cost producer benefits disproportionately more from rising prices compared to a high-cost one.
So beyond just a nice profit number, how does that potentially translate into value for investors? More tangible benefits?
Well, higher profits usually mean stronger free cash flow. Now, definitions vary a bit. Newmont, for example, is clear their calculation excludes things like debt payments. But generally, it's the cash left over after running the business and investing to sustain it. And more cash gives Artemis options.
Like what? Paying down debt.
Paying down debt, yeah, which they likely have from construction, funding future growth, maybe exploration or expansions, or eventually maybe returning capital to shareholders through dividends or buybacks, though we don't have details on their plans there from these sources.
And any idea what low means in context? You mentioned using benchmarks.
Yeah, just for perspective, not a direct comparison since we don't have Artemis's number here, but a major like Newmont was guiding towards an AISC around $1,170 to $1,180 per ounce for the big operations in 2025. So that gives you a ballpark for large established players.
Okay, that helps frame it.
Yeah.
Now, let's shift gears to the Lassonde Curve. You mentioned it earlier. Artemis obviously wouldn't put it in a press release, but hitting commercial production feels like a textbook moment on that curve, doesn't it?
It absolutely does. For anyone unfamiliar, the Lassonde Curve just shows the typical share price journey for a mining company.
Wow.
You often see excitement during discovery, then maybe a lull or volatility during the long development phase where the risks are highest financing, construction, permitting.
The orphan period.
Sometimes called that, yeah. Then the transition into production, where Artemis is now, that's often seen as a major de-risking point. The speculation starts turning into reality. They're moving up that curve towards potential cash flow generation.
And here's the million-dollar question, maybe literally for investors.
Yeah.
Does this move into production typically spark that re-rate in the share price?
Often, yes. Historically, it can be a significant catalyst. The company profile changes, right? It's not just a plan on paper. It's an operating mine generating revenue.
It attracts different investors?
Potentially, yeah. Investors who perhaps avoid the higher risks of development might now take a look. We saw an analogy, maybe, with Silver Lake Resources. IFM investors noted they outperformed after a merger brought in cash flow. Achieving your own production and cash flow could have a similar effect for Artemis.
Could. So it's not guaranteed.
Definitely not guaranteed. It really hinges on execution.
Oh.
Can they consistently hit their production targets? Can they actually deliver those low costs they're projecting?
Right, manage the operations effectively.
Exactly. And market sentiment plays a role too. If the overall gold market is weak, even good news might not lift the stock as much. So it's a potential catalyst, but performance has to back it up.
Okay, that makes sense. So let's assume they execute well, and let's say the gold market stays strong, or even gets stronger, like some analysts suggest. How does being a low-cost producer specifically amplify their performance? Let's talk more about that gold price leverage.
Right, the leverage, it's pretty straightforward conceptually. If gold goes up by, say, $100 an ounce,
Yeah.
that full $100 flows straight to the pre-tax profit line for every producer.
Yeah.
But for a low-cost producer, that $100 represents a much larger percentage increase in their profit margin compared to a high-cost producer whose margins were already thin.
Ah, okay. The impact is magnified.
Precisely. Their profitability scales up much faster with rising prices. If Artemis achieves genuinely low AIS, say well below the industry average, and gold continues its run.
Like Discovery Alert mentioned, seeing spreads over $1,500 an ounce between AISC and the gold price for some operations.
Yeah, exactly. If Artemis can achieve costs significantly below average, their potential margins in that kind of price environment become, well, very substantial. They'd be exceptionally well positioned to generate significant cash flow.
That paints a clear picture of the potential upside. But we have to balance that, as you said earlier, with the risks. Artemis right now is reliant on Blackwater. What are the main dangers of being a single asset producer?
Concentration risk,
Oh, yeah.
basically. Everything hinges on that one operation. If there's a major operational problem at Blackwater, a pit wall issue, equipment failure, processing plant trouble,
The whole company feels it immediately.
directly, yes. There's no other mine to cushion the blow. Same with external factors, a localized strike, severe weather events like wildfires, regulatory changes specific to that region.
Geopolitical risk, even within a stable country like Canada.
Well, yes, even provincial policy changes or permitting issues can disproportionately affect a single asset company. And of course, their entire fortune rests on the geology and performance of that one ore body.
So acknowledging those risks, what has Artemis done to try and mitigate them? To de-risk Blackwater specifically?
They've actually ticked quite a few boxes over time, getting construction to, what was it, 87% complete and on schedule by last July was huge. Now announcing commercial production is the culmination of that, massively reducing development risk.
Okay, construction risk largely behind them. What else?
Funding. They stated the project was fully funded back then, which removes a major financial uncertainty that plagues many developers.
Right.
They also got their initial mining fleet, the big excavators, haul trucks, loaders, built and commissioned last year, ready for operations.
So the gear is ready.
The gear is ready. They brought in key operational personnel early for pre-commissioning activities. That suggests a focus on a smooth ramp-up.
And what about the non-technical risks? Social license, community relations.
Very important. They highlighted their agreements with indigenous nations, the participation agreement with Huskas Dene Nation and Olcacho First Nation going back to 2019, and a cooperation agreement with Nazco First Nation from 2021. KPMG flags social license as critical in mining.
Absolutely.
So having these agreements in place is a significant de-risking step. They also mention ongoing talks with other First Nations.
And they handled that wildfire situation last year, too.
They did. Their proactive response to the evacuation order, getting people out safely and then remobilizing efficiently, showed operational readiness for external shocks.
So quite a few proactive steps taken. But even with all that, some inherent risks must remain, right? Just by virtue of having only one mine.
Oh, absolutely. You never eliminate all risk. Permitting, for instance, while they have permits for the current phase, future expansions or modifications might need new ones, which isn't always straightforward. Geopolitical stability is generally good in BC, but, policies can evolve. Operational hiccups can always happen, even in well-run mines. And commodity price risk is ever present, although low costs provide a buffer.
And just the challenge of consistently hitting targets year after year.
Exactly. Maintaining consistent production, keeping those costs low over the long term, managing grade variability. These are ongoing operational challenges for any mine. And for Artemis, they're all concentrated at Blackwater. KPMG's point about permitting and geopolitical uncertainty being key sector risks still applies.
Okay, this has been incredibly insightful. So to sort of wrap things up for you, the listener, Artemis Gold hitting commercial production at Blackwater, especially with the prospect of low costs, is genuinely a major achievement.
It is a pivotal moment.
It has potentially very positive implications, particularly if gold prices remain strong or head higher. They've clearly taken significant steps to de-risk the project along the way.
Construction, funding, agreements. Yeah, a lot has been done.
But, and it's an important but, the fundamental risks tied to being a single asset producer haven't disappeared entirely. That concentration risk is something to keep in mind.
Definitely. And maybe a final thought for you to ponder. How sustainable are those projected low costs? What happens over the mine's life? Does Artemis have exploration potential beyond Blackwater that could eventually diversify them? That wasn't really in our sources today, but it's a key long-term question.
Good point. And how will their performance ultimately stack up against the wider industry trends and risks we've touched on?
Exactly. Things to watch.
All right. Now, just our standard but very important disclaimer. Please remember, everything we've discussed today is based on publicly available information up to Friday, May 2nd, 2025. This is not financial advice.
Not at all.
Any investment decisions you make should come after you've done your own thorough research and ideally consulted with a qualified financial advisor who understands your specific situation.
And be aware, as Artemis themselves always state, that forward-looking statements about costs, production, and so on involve risks and uncertainties. Actual results could differ.
Couldn't have said it better myself. Thanks for joining us for this deep dive.